Major private equity firms are some of the most sophisticated real estate investors in the entire industry, with access to almost unlimited in-depth market data, top-tier talent working on deals, and complex proprietary financial models that they use to make cash flow projections and analyze properties. But after working at these types of firms myself for almost 10 years, I've seen firsthand that when it comes to valuing commercial real estate, there's a pretty standard process that's used across the board that's not quite as complex as you might think. So in this video, I want to share with you exactly how real estate private equity firms come up with offer prices on commercial properties, the core drivers of pricing that these investors are focused on most, and how you can use these same strategies to improve your own real estate investment decisions when building your portfolio. So to first step back and start with the fundamentals here, by real estate private equity firm, I'm just referring to a company that raises third-party capital from passive limited equity partners that want exposure to real estate but don't have the time, resources, or potentially even the knowledge necessary to make these investments themselves. And when these companies raise money from limited partners, these LPs will be looking for a minimum target return on their investments, which is really the core of where property valuations ultimately stem from. These target returns are generally tied to the annualized time-weighted return on a real estate investment, factoring in both cash flow from a property's operations and cash flow from the ultimate sale of a deal. And to measure the time-weighted annualized return, the IRR, or internal rate of return, is almost always the main benchmark used by real estate LPs, since this not only factors in all cash flows on a deal, but also takes into account when each of these cash flows is projected to occur. But even if an investor knows that they want to focus on the IRR, they still need to choose a minimum IRR target, and this is where what are referred to as capital risk buckets start to come into play. Capital risk buckets are essentially used to help an investor determine what their target IRR should be based on the business plan and the risk associated with an investment. And in commercial real estate, these break down into four main categories, which are core, core plus, value add, and opportunistic. So to start off with the lowest level of risk, we have the core bucket, which tends to include newly built properties in major gateway markets with strong credit tenants that are often financed with very conservative levels of debt or no debt at all. To use an example, this could be an office building in Manhattan built in 2022 that's currently 100% occupied by Google on a 20-year lease with a very low risk of default by the tenant, very little or no renovation needs of the property, and a very high probability of being able to re-lease the space to another quality tenant at the end of the lease term. On core deals, investors will usually expect levered IRRs, or internal rate of returns, after factoring in debt of anywhere from about 7% on the low end to about 9% on the high end, and investors are usually looking for these deals to be held long term over about a 7 to 10 year hold period overall. Core deals are basically your trophy case assets that involve very little risk and are usually sold for a premium, but are also very, very likely to perform consistently over time. Now from here, if investors are willing to take on a slightly higher level of risk in exchange for a slightly higher target IRR, this brings us up to the core plus bucket, which will usually include acquisitions of relatively new properties with only a small handful of capital needs or operational adjustments that are also usually located in established and growing secondary markets. An example of a core plus deal could be an apartment complex built in 2015 located in Seattle just outside of the city center with some cosmetic upgrades that could be made to the property that would allow an investor to moderately raise rents without much or any risk at all associated with the business plan. For core plus deals, investors will usually expect a levered IRR of somewhere between about 9% on the low end and about 12% on the high end. And again, investors will generally be looking for a relatively long-term hold horizon on these deals, usually somewhere between about 7 and 10 years. Ultimately, core plus deals are usually relatively new, relatively well located, require very small changes to add a small amount of value, and just one step up from core deals from an overall risk perspective. Now, for investors that are comfortable taking on even more risk than this in exchange for even higher projected returns, we'll move into the next capital risk bucket, which is the value add bucket. Value add deals tend to require a significant amount of renovation and or releasing efforts to increase rents at a property and ultimately increase NOI, with investors often using high levels of leverage to manufacture higher returns. An example of a value add deal might be a retail shopping center built in 1990 that's currently 80% occupied in a growing submarket on the outskirts of downtown Miami, with a significant number of below market leases at the property that could be released at current market rates. For value add deals, because of the risk and the speculation that comes along with construction and releasing, higher levels of leverage, or betting on the continued growth of an emerging market, investors are usually looking for an IRR of somewhere between about 13% on the low end and about 16% on the high end on these deals, with a relatively shorter hold period expected of about 3 to 5 years in most cases. Value add deals tend to be your typical bread and butter renovation and releasing plays, but with these things come the risks associated with cost overruns that could put a project over budget, a weakening economy that doesn't allow investors to raise rents as planned, or rising interest rates that could cause significant cash flow issues if NOI growth doesn't end up materializing. Now, for investors that are looking to maximize projected returns and are also willing to take on a significant amount of risk to get there, we have our final capital risk bucket, the opportunistic bucket, which tend to include acquisitions requiring a complete repositioning of a property or the ground up development of an entirely new structure overall. And these deals also usually incorporate very high levels of debt in order to boost returns. An example of an opportunistic deal could be an investor buying a 50% occupied office building in San Francisco with a plan to convert the building into 4 rent apartments, with the investor being willing to take on a massive renovation budget and a speculative lease up once that renovation is complete. On opportunistic deals, investors are usually looking for IRRs of anywhere from about 16% on the low end to 20% or more on the high end, with these types of investments involving business plans with the highest levels of risk. And ultimately, these deals are really the big swings that real estate investors take to try and hit home runs, while also accepting the fact that things could go a lot differently than planned and potentially in a negative direction. Now, these ranges can shift slightly up or down over time based on the risk-free rate in the market, with investors sometimes looking for IRRs that are slightly lower than these ranges when interest rates are particularly low, and slightly higher than these ranges when interest rates are particularly high. But at the end of the day, these are what are used by investors to come up with a target IRR on a deal that ultimately drives pricing and valuations across the market. And if you want to learn more about capital risk buckets, target return metric valuation, and how to use all of these things within a real estate financial model, as always, make sure to check out our all-in-one membership training platform, Bringing a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on deal analysis and property valuation, make sure to hit the like button and let me know in the comments which return metric you focus on most when valuing commercial real estate. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.